Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Great. Hey, Gio, welcome.
Hi, glad to be here. Thanks for having me on.
Yes, I'm super excited. Geo Chen, who runs Stratosphere, a family office. Headline is have generated over 900% in the 4 years or so since he set up shop as a family office. And with a very ambitious longer term goal to generate enough profits for his foundation, which is doing a lot of good. Gio, again, I'm so excited to have you in the show in this Wizards Learning Series for audience and to learn how you do it. We'll break this talk into a few sections. Obviously, get your bio, who you are. Love to also hear your overall strategy for Stratosphere, your family office, what makes you tick. Then migrate to hearing your views of the macro world. The macro drives a lot of your strategy. And then hearing about your allocation and then diving deep into a couple, depending on time, a couple of the asset classes that you favor and why and how you invest. And then we'll wrap that up from there. How does that sound?
Yeah, sounds good.
All right. Okay. So tell us about yourself, Gio.
Yeah, so I grew up with a pretty diverse background, lived in a number of countries, including Hong Kong, Korea, US, and Taiwan growing up. So I think that kind of colored my my experience and made me want to have a career that was, somewhat global. And I think that helped a lot in my decision to become a global macro trader at the end of the day. So I spent a lot of time in Taipei, then went to university in the US, spent some time in London as well. That's where I had my first real job. And then I ended up working for banks in New York and Singapore for about 15 years, doing FX trading.
Got it.
So I moved to Singapore back in 2010 to continue doing FX trading and eventually was running a FX trading desk here in Singapore.
Great. Are you originally from Singapore, or born in Britain? Where's your family?
The US. Yeah, US, and also with Taiwanese roots.
Gotcha. Okay, great. Okay, then tell us about this family office. Why did you start it, and what was the motivation, and I guess the objectives then and now?
Yeah, so the family office really started from me just trading my personal account, and I decided when I left banking, I really wanted to just focus on trading my personal assets and see what I could do with it. And my view was that I could make a lot more doing that than what I could earn trading for a bank with the annual salary and bonus and stuff like that. And by then I was pretty confident of my ability to generate returns year in and year out. Never had a losing year. And so, it was just a bet on myself. And, the trading has gone well. And since then I've branched out into other asset classes like real estate, venture capital, private equity, hedge funds, and behaving more like a family office that allocates across different assets.
Okay. So I think there isn't a set definition of family office, but when I think of a family office, I don't really think of trading. I think of someone that whether it's a single or multi, whether it's a principal or third party, having a sum of cash, sort of investing longer term, right? But it's interesting, you started trading. Can you kind of talk us through that? And and how that's evolved over the last 4 years?
Yeah, every family office is different, and for mine, I think in some respects it does everything that the typical family office does, except as you say, we kind of have this uh, internal hedge fund or trading our own assets, because that's what trading is what I love doing, and that's what I'll always continue to do. So large amount of assets and risk are devoted to global macro and equities. Equities has been more of a recent thing, because last June, after we had kind of recovered from the bottom, and I saw that the Fed was pumping as much liquidity into the system as possible, I realized that we were perhaps in the beginning stages of a raging equity bull market. So I realized that I need to be in the single stock equity game. It's not enough to just be trading equity index futures. So that's what I did, so now we do both global macro and equities.
Okay, so tell us about this 900% return. What happened? I mean that's just staggering, right?
Yeah, so back in 2017, 2018, I mean, I had okay years. They were between 30 to 50% for those years, and 2019 as well, roughly around there, which I thought was a decent return by my standards. Then 2020 came along, and I got a lot of things right. I saw COVID happening and spreading throughout the world early in January, and still in February, the US markets had not caught on yet. There was a huge lag between what was pretty obvious to me and some other people in the markets, that what kind of impact COVID would have on the market. So I managed to take some really big asymmetric bets on that through interest rate futures, through being short S&P and long S&P puts, short EM FX, and had a really good Q1. And that was probably around like a 25 to 30% return just in that quarter itself. And then spent Q2 kind of thinking about where do we go from here. The market's already rebounded a little bit. Economic fundamentals were still horrible, but we had all this liquidity in the system, more liquidity and stimulus that the world had ever seen. So nobody could really model this out and tell you exactly what was going to happen. So after remaining bearish for a couple more months, I decided, I kind of saw the light and realized that this was all really bullish, despite the horrible economic fundamentals. So I basically flipped my entire book to being bullish, equities, short the dollar, and from there, I realized that precious metals were going to be on the verge of a large, uptrend, and they had recovered quite a bit from the lows, gold and silver, but they hadn't really broken their highs. So there was a bit of a delayed reaction in the precious metals as well. You would think that with so much stimulus and so much money printing, they would just be ripping the new highs, but they were still hanging around. But so in July, August, beginning of July, I started to get long gold and silver through the futures and options. and they had a really remarkable bull run during July and August. So I managed to capture a lot of that and got out pretty much on on the days when on the day when they both made their high. So those were two big contributors to the year. What contributed to it ended up being like a 250% return just for the year alone. And then in Q4, I saw what was happening with PayPal adopting Bitcoin, and to me, crypto was always an asset class that I'd been watching, and I always thought I'd been involved in crypto back in 2017 and 18, and unfortunately I got out just right after the crypto market made a high, and I always thought that for me to get bullish crypto again, one thing had to happen, which was mainstream adoption. And with the PayPal announcement, that kind of satisfied that condition. So I started to get long Bitcoin futures, and that became a large part of my allocation. And since then, so we all saw what Bitcoin did in November, December, and the beginning of this year. So riding the uptrend in Bitcoin has been another contributor to the returns. Yeah. So basically, three pretty big trades in the year, as well as going long equities as well, which was another contributor. That's what put together the big year.
Gotcha. And that's the course of the 4-year history, right?
Those are the main
trades.
1 year alone in 2020. Yeah.
Oh, okay. And when you do these trades, all of these are levered, right?
They are, yeah. So I use futures a lot, which are always levered. So that requires pretty active risk management. When I put something on, like the long gold and silver trades, or the long Bitcoin futures trades, I put on pretty sizable positions. When I have high conviction on a view, the exposure that I take into those assets could be anywhere from like 30 to 50% of my overall net worth or assets. But I risk manage it very well. Like the key for me is to get the timing right of the entry, get the exit right, in the sense that I don't want to be hanging around in the trade too long and let it reverse a lot against me, and I end up giving away a lot of profits.
Okay.
Yeah. So, and if I'm wrong, then I'm ready to cut it and take a small loss.
Sure. Okay. A lot of commandments you're practicing from the book.
Yeah.
We should have talked to you before we published the book and add your advice to that. Typically, how long are your trades or your holds?
The time horizons are these days it's around a month. I guess like sometimes I'll put something on with with a several week time horizon, but with most big trades, it's usually a month or more. Sometimes I might have a view that a year plus time horizon.
Mm.
And that doesn't necessarily mean I'll hold it for a year plus, but my view is sometimes that, like, you know, over the next year, I think this asset could do this, or this trend could extend itself over the course of the year, or something like that.
Sure, sure. Good stuff. Gio, again, when I think about a family office and when I think about investing versus trading, and I'm looking for principles, systems that are scalable and repeatable and sustainable from investing standpoint, right? You've done an amazing job in the short history of your family office. However, what I'm hearing is these are really short-term trades, and it's something that you obviously are very adept at. You've got the background, you've got the brain power. It's not something that I, for example, am capable of, because it's just not my background, or certainly it's not something that I'm experienced at. So how repeatable is what you've done? Because a cynic would say, you know what, I could have bet January 1st that Ethereum would double. I'll leverage up 5x and I'll have my 10x, right? And I have friends that have done that. And they would have done a fairly safe bet, because the trend there, even prior to PayPal buying Bitcoin, in terms of number of transactions on crypto and Ethereum developers, it's actually quite clear, right? So how would you address that? And how would you, as your AUM grows, or if you were teaching my daughters how to do what you do, what could they take away from that to make this, you know, more repeatable and sustainable and scalable? Does that make sense?
It's a really good.
Yeah,
it's a really good question. It's a good question, and I agree that, you know, that's the key to someone who has, you know, hit like one big trade and got lucky, versus someone who is going to do this over and over again for the rest of his career. And I would say 2020 was anomalous in the sense that, you know, we had like multiple huge global macro shifts and trends and volatility events all compressed within a year. That's not normal. Like, typically, you know, you might have one or two major volatility events or global macro trends that you can really like make a lot of money on. So 2020 was definitely unusual. But for me, you know, being a global macro trader, there are always going to be, you know, huge trends in interest rates, commodities, equities, and crypto as well. So my, you know, the way I work is that I always want to stay on top of the fundamentals of all these different markets and kind of map out how they move in relation to each other, and also how they respond to fundamental changes. And right now we're in a very volatile macro environment, in the sense that, you know, we're coming out of a deep depression, a very sharp recovery, with very fast growth and inflation, and then, you know, we have a lot of stimulus being done by the Fed and the Treasury, and you're going to get a lot of just macro volatility swings from inflation to maybe like, oh no, maybe inflation is not going to happen, to, oh no, inflation is really happening. And along with that, you're going to get really large swings in asset prices. So, you know, what I do is I want to stay on top of all this and be able to make money on both the long side of crypto and the short side, the long side of equities and the short side. To me, like, I'm not a perma bull or perma bear in anything. I want to see, you know, where the water is flowing before everyone else sees it. So for me, you know, it's just part of the process. Being able to, you know, do the fundamental research, being able to figure out how to express my fundamental view in the market in the most, you know, asymmetric, efficient way possible, and then be able to time the entry and exit of that trade and risk manage it well.
Okay. And it sounds to me like this strategy, as long as you're actively trading it, it should work in any market, right?
Yeah, that's the idea. It should work in, you know, bull markets, bear markets, high inflation, low inflation, and anytime there's volatility, there's the opportunity to make money.
In terms of what you do, let's say one of our listeners, most of our listeners don't have your background, right? And what would you teach them from what you know if they wanted to tap into your wisdom, your knowledge from an investment standpoint? What are some of the advice, principles, commandments that you would sort of, given obviously your tremendous success in the past couple of years, what are some of the things that somebody that isn't of your stellar background or technical background or trading background could take away from that you could advise?
Yeah, I think you know, a lot of retail investors have become very educated over the past, I guess, 5 years about global macro. It seems like the press and also you know, the Twitter or blogosphere does focus a lot more on global macro shifts, like what's happening with inflation, what's happening with stimulus. You know, if you go on Wall Street Bets, like, everyone knows who Jay Powell is and what he's doing. You know, Fed go burr. I mean, there's like all these memes out there. Like, investors are more global macro aware than ever before, and there's a lot of resources out there. You know, on Twitter, and you know, realvision.com is also another one that's really good for educating investors. So, and I think right now, like, global macro is influencing asset prices more than ever. Inflation is influencing, you know, the movement of stocks and sectors within the market. So even though, you know, you just see the S&P kind of grinding up and up and up, but under the surface, you know, you see growth. We've seen growth stocks like really just have a really strong uptrend, and suddenly over the past couple of months, you know, they reversed and sold off massively. And you know, this is the influence of global macro factors like interest rates and inflation and growth. The whole rotation from growth and tech into cyclicals and value. So I guess my advice would be to, you know, try to find some good resources for research or ideas or news on the global macro front, because and continue to educate oneself on what, you know, the overall global economy is doing, the pace of money printing, the pace of inflation, because those are all going to affect asset markets a lot going forward, as they have over the past year.
Sure. Okay. Let's spend some time on allocation. I'm not sure if you're at liberty to say your AUM, but whatever that is, how you allocate it?
So for me, one of the bigger allocations that I focus on is what percent of the investable assets are in equities, exposed to equities. That's what I try to dial up and down, anywhere from like 30 to 60%, depending on how bullish or bearish I am. And then if I happen to get bearish, like I might, sell some equities and also go short index futures. And I have the ability to go down to 0%, if I want to.
Sure.
And then there's, allocations such as like how much I want to have allocated to illiquid venture capital, real estate, and private equity investments. To me, liquidity is very important because having liquid assets is key to trading. If I have a drawdown, like how much liquidity do I have to continue to trade the size I want to trade? So I need to monitor that pretty carefully. So for illiquid investments, like I want to cap that at 20%. I don't want to have any more than 20% of my net worth in illiquid investments.
Okay, and this is all this is all cash, right? Not including leverage or anything, right?
Oh, so illiquid it would be like allocations to venture capital, PE, and
Real estate.
real estate. And by liquid, I mean anything that's in trading accounts, cash as well.
Sure. Yeah. Sorry,
Yeah.
my question was these are pre-leverage allocations percentages.
Yeah, pre-leverage. So yeah.
Gotcha. Okay. So let's now where would you put crypto under liquids or illiquids? It would
liquid.
be under the most of it is liquid. Well, the top ones are liquid. It depends on we talk, but that would be under the liquid side. Gotcha.
Yeah.
Gotcha. Okay. So what are you favoring right now and why?
So I think we're entering a really tricky time this year. Equity markets are kind of melting up, at least the S&P is. And you see like implied volatility and realized volatility really grinding lower. And in the past, when I've seen this happen, it tends to continue for a few months, but then it's not sustainable and it often results in some kind of volatility event, downside for equities. So I'm trying to stay nimble. I'm still long equities. I'm still bullish equities for now. But at the first hint of trouble, whether it's triggered by something fundamental, or by some kind of technical reversal in the market, I'm ready to get out of equities and go and reduce my exposure or even go net short if I can. And what's interesting is that inflation has become a huge narrative, a huge theme for the markets. I think it's already become consensus. Over the next couple months, we're going to see some really large inflation prints, large GDP prints. All the data is going to be really good, but I think the market has already positioned and for all this and priced that in. So from here, I think the risks are skewed to, what if inflation doesn't roar back as strongly as it did? What if it does, but come out on the other side with like inflation rolling back over? We have these a few factors into play that are countering this inflation spike. First of all, China right now is I guess arguably running neutral to tight monetary policy because they came out of the recovery a lot faster, and they're further along in their I guess mini economic cycle. You have the issues of technology and demographics always causing downward pressure on inflation, so resulting in disinflation. So we're in a situation where you need the Treasury and the Fed to keep stepping on the gas in order to create inflation. The moment they lift their foot off the gas, I think we're going to mean revert and fall back into disinflation. So for me, I think there's no more money left betting on reflationary or inflationary trades. That that has already passed. To me, the money will be made by betting the other way. So maybe going long, shorter maturity treasuries or Eurodollar futures. It's basically betting that the Fed is not going to hike as quickly and as much as the market thinks. And if we see some kind of correction in equities this year, I definitely hope to be able to catch that. Maybe by shorting Russell equity futures, Russell 2000, or buying puts, maybe going long VIX or call options on VIX. And crypto as well. I mean, people have made a lot of money on crypto over the past 6 months, and we've seen this enormous growth in crypto, DeFi and lending and borrowing infrastructure that has literally just popped out of nowhere in the last 6 months. It's huge now, and I don't think it's ever been tested before. So, what happens if Bitcoin drops like 50%, which it has done many times in the past, not recently, but it has. This whole web of centralized and decentralized borrowers and lenders has never really been stress tested. So I think there's the risk for a volatility event in crypto is rising. So I'm just, same with equities. Like I'm bullish, but I'm ready to get out and flip to short if I see, any kind of trouble, whether it's fundamental or technical reversal in the market.
Yeah. I have a few questions for you on the crypto side, Geo, but let me just do a follow-up on the allocation. So I don't know the exact numbers, but I've heard a few times that the developed countries on the QE side, quantitative easing, have printed so much money that we're seeing probably an average of 15% a year, which means depending on which country, in 3 or 5 years, we're going to see the dollar and most major fiats half in value. Hence, whether you're holding real estate, equities, bonds, really any asset that's tied to fiat would basically be discounted by half. But do you see that as well, first of all?
I think it's quite possible. I think Yeah, it's you know, especially with what the Fed and Treasury are doing, they're highly incentivized to generate persistent inflation, highly incentivized to print more money because you have a really large debt to GDP ratio right now in the US. You have, I think it's at 130%, and uh, whenever you get above 120% in debt to GDP ratio, that tends to have a large drag on the nation's growth and inflation, and you kind of get like this Japanification effect. So, you know, they're highly incentivized to get the denominator, GDP, higher. And you could do that by creating real GDP, and also inflation, because inflation is a component of the nominal GDP. So yeah, I think we're probably going to get there, but it's not going to be a straight line. It's going to be a very jagged line. And even when you look at the the inflation that happened in the 1970s and 80s, if you look at a CPI chart, it was like this. It was like three peaks, like with a third peak being the highest, and then a very sharp decline once Volcker decided to hike interest rates and get rid of inflation. So my goal is to be able to navigate those peaks. So not just say like we're going from here to there in the course of 10 years and just like hold on, but my goal is to be able to make money on the peaks and troughs.
Yeah. Okay. Yeah. Again, you're lucky. You're very lucky because you've got that skill set. I'm just. I guess for me, I'm maybe a bit more I'm pessimistic in the sense that the governments are not only highly motivated to continue printing, but they have to keep printing. And historically, even in China, we've seen thousands of years ago, it has happened before, right? So my view is the probability in 5 years from now, the US dollar, the Canadian dollar being worth 50 cents of today or maybe 70 cents today, it's much more likely than it is worth being $1, right? So if that is true, then again, beyond obviously being a super smart trader, and let's say it's not 15%, but it's 10 to 50% deflation a year, where do you put the money from an investment standpoint?
Yeah, that's a really good question. I think I guess like crypto is one of the answers, because you have a limited supply of Bitcoin. Not all cryptos have limited supply, but that's why everyone's allocating to Bitcoin. And in the long run, I think Bitcoin's going to do great. Like it could drop by 50% at some point this year, but then it'll be a buying opportunity. So I guess for anyone, the question is whether do you want to just have a long-term allocation and set it and forget it, or do you want to aggressively like try to position yourself for have a larger aggressive long position that you risk manage and get out if things are getting too hot or if you're seeing a rollover. And I think that's the question that everyone needs to ask for themselves. Like, are they just going to be a hodler and do thick and thin, or try to ride the waves? And the other one is real estate, right? Real estate tends to appreciate during times of inflation and monetary debasement. It's a hard asset. It gives you income. So hopefully it's not too late for that, because real estate prices have gone through the roof all around the world. But I do think that you do want to have some real estate exposure or have some of your assets in real estate.
Yeah, yeah. I think we're thinking along the same lines. So I wanted to ask you favorite asset classes. I think you're also invested in stabilized rental buildings, right? Which probably paying
Yeah,
the 8 to 10% cash and cash, maybe on a 3 or 5 year basis, you look to double your money or at least 1.5 times your money, which
yeah,
which is great. And in the worst case, if inflation does have your value of that asset, then at least you're keeping pace, right? um,
yeah.
um, and then even in equities, if inflation is 15%, then you really have no place to go but growth stocks that grow faster than that, right?
Yeah, it's funny with like equities and their relationship to inflation. I think the general, like people generally say, well, equity should go up, during times of inflation, but it's actually a lot more nuanced than that. Um, it also depends on like what the market's expectation is for interest rates, because if the market expects interest rates to go up by a lot, that actually ends up hurting growth stocks. And that's why they've taken a hit over the past couple months. Because when the a couple of reasons that happens whenever you do the NPV calculation of these growth stocks, you have the denominator, which is increases as interest rates go up, and that basically reduces the valuation. And also, as interest rates go up, the risk equity premium kind of compresses. So valuations have to fall in order for your earnings yield to kind of like keep up with higher interest rates. So I feel like in an inflation environment, I think like value tends to do a lot better. Cyclicals tend to do better. Low PE stocks, definitely do well. And when it comes to tech and growth, like definitely want to be more on the growth at a reasonable price, or at least like have stocks in a portfolio that have a PE of 50 and less when it comes to tech.
So in a higher inflationary environment, if you held a value, let's say the value on average long term goes up 7-8%, but inflation above that, you're basically losing money, right? So it seems just counterintuitive to me. What good is
Yeah,
that asset? What good is that asset investment if it's going to be net -2, -5% because of inflation? So again, in my view, I do believe inflation is going to be double digits on average, longer term, right? In which case, again, if you're trading and you're doing a lot better than the market, that's a little different. I'm just curious how you would play that if you're not leveraging and trading.
Yeah. Well, so let's say inflation was going to go into the double digits. I feel like the reason growth would not do as well is because the revenues and the earnings of those growth stocks are never like today or next year. It's always in the distant future. So the higher inflation you have, like the more those future earnings are basically discounted.
Yeah,
And
understood. Yeah.
yeah, so that's why like they want, people want to like low PE during that kind of regime. People like to own value stocks with like low PE where the earnings are today. right? Like you're getting I don't know, like a 5 to 10% earnings yield today. And what was the other thing I was gonna say? Yeah, but I don't think we're gonna get like double-digit inflation. I mean, I do think it'll rise over time, but I don't think we'll go back to the inflationary period of the 70s and
Really?
80s.
Huh.
Yeah, I think
That's I think that's a straight math, right? How much money how much M2s increase? It's certainly a lot more than
yeah,
double digits. I mean,
there
if you print 15%, it's going to go somewhere. If you print 30%, it's going to go somewhere, right? How do you counter that?
yeah. So there are a number of reasons. So first of all, we printed a lot of money after 2009, and we didn't get a lot of inflation at all. And that's because inflation does not just come from money printing alone. It also comes from the velocity of money.
Yeah.
So money supply goes up, but velocity of money goes down, and that negates a lot the effect of all the money printing. So I don't expect the velocity of money to go up a lot this time around. I think it'll probably keep trending lower. And what I'm seeing is that banks are not really increasing their lending to the customers that much, and so that's a sign that velocity of money is not going up. Also, in the 70s and 80s, you had some pretty huge spikes in oil from the oil embargoes. You had much larger unionization of workers, much more than we have today. So that contributed to the wage price inflation spiral.
Okay.
And also demographics were much more favorable to inflation back then, and now they're, if anything, they're much less favorable to inflation. You have like basically China, Europe, and Japan have demographics where the birth rate is basically just like declining precipitously, especially in China, because China is suffering from the effects of this one-child policy. So the demographics are going to be a big headwind towards growth in inflation in China going forward. In the U.S., demographics are also a headwind, not as much as Europe and China, but still a headwind.
Okay. Well, Geo, that's, I think, probably a contrarian view about inflation. I actually hope you're right. I appreciate that. Yeah. Let's move on to crypto. It's a very interesting topic. Like, how long are you in crypto? Let's say 4 years ago, and where are you today?
So right now, I think the allocation is like close to 30%. Close to 30%. Via like various instruments like futures and grayscale and whatnot. And I can, for me, like, it's been 30% for a while, so it's been a good couple of quarters. But I feel like based on what I was saying, that we could get a sharp correction at some point later this year. I'm ready to dial that back down to zero, or even go net short if I see an opportunity to do that.
Okay. So got it. So I get grayscale. You can get a lot of exposure through that. How else are you getting exposed to crypto?
Yeah, so Bitcoin, futures, and they also came out with Ethereum futures. So so you could get long exposure to those two as well.
Okay, so you primarily on the top two.
Yeah. Yeah.
Okay. Okay.
At the
Do you look
moment,
at
I'm in the top two.
Gotcha. Do you look at
Altcoins,
altcoins?
altcoins I've messed around with before, but at the moment it's not a big exposure for me right now. For me, the thing with altcoins is that like um they're not that as liquid as I would like them to be. So for me, like if I'm in a place where I want to be able to risk manage and be able to like unwind all my positions pretty quickly, it has to be in Bitcoin and Ethereum.
Mm, gotcha. Okay. Gotcha. Gotcha. Okay. Yeah. And again, your positions are, you're not buy and hold. You're really trading and looking at momentum and technicals.
Yeah, I would say I'm definitely not buy and hold. I mean, it would be great to just hold stuff forever and not have to worry about it. But what inevitably happens is that I see some kind of risk on the horizon brewing up at some point, and I end up selling it for better or
Hmm.
for worse.
Interesting. Yeah. I was listening to the MicroStrategy guy. He had an interview with CZ at Finance. And again, I haven't checked this data. He says in the long term, I'm not sure if he means 10 years or 20 years or 5 years, Bitcoin, the trend is very clear, right? Short term, daily, weekly is not clear. And he says in the last 90 days or 60 days, Bitcoin is actually much less volatile than, let's say, a Tesla. And quite a few even Apple, he says, he mentioned it's been less volatile. So it's quite interesting that the perception is it's quite volatile, and maybe early on it has been, but it seems to have stabilized quite a bit.
Yeah, it's interesting that the volatility has really compressed, both implied and historical volatility. But the thing with volatility is that when you get volatility compression like that, the market gets complacent. And we've seen that time and time again in equities. Like back in 2017, I think equity volatility, both realized and implied, got down to 12, which is ridiculous. Today, up until recently, it's been closer to 20. So low volatility often begets high volatility, and that's just something to look out for over the next 6 months or so. People might get complacent. They might think, oh well, I can sell, I guess, like calls or sell puts on Bitcoin, and they're trying to like squeeze more out of that short option strategy, but they're really just increasing the risk and exposure as volatility compresses.
Okay.
Yeah.
Gotcha. Do you ever get into certain things like reading the white papers of these coins and looking at the applications and teams at the fundamental level, or I know that you also invest in VC funds and whatnot. So do you more outsource that to the GPs?
Yeah. I read some white papers. I probably understand like 60 to 70% of them.
Hey, that's pretty good. That's pretty good. Either you're much smarter or the white papers have gotten better. Yeah,
yeah, I mean, the some of them can be somewhat technical.
Yeah.
Yeah, with VC, a lot of my exposure is through managers, and I do like to look at companies. I like to learn about them. I read a lot of pitch decks, and but a lot of the exposure is through managers. I'll do an occasional like direct investment here and there if I have a strong view on an industry or like a idea or sector or trend. I'll take a direct investment. every once in a while.
Yeah, yeah, yeah. Passion or a fun project. Gotcha.
Yeah.
Good stuff. Good stuff. Why don't you tell us about your foundation, Gio? And I know you've got a big heart for the environment, and you mentioned you want to grow your foundation to $1 billion to help people. Tell us about that, the work that you're doing, and what motivates you.
Yeah. So my wife and I started the Huang Chen Foundation last year, and it was a long-term goal to be able to create the foundation in order to kind of formalize our philanthropic effort in basically like moving profits from trading and into NGOs that are doing good. And so we focus on nature conservation, wildlife conservation, the climate crises, refugee crises. So basically trying to address the root causes of climate change, as well as address the I guess the results that are happening today, you know, the humanitarian effects of climate change. And so for me, like I believe that you know, climate change is the biggest existential problem that the world has today. And you know, obviously, a lot of people are devoting their time and expertise and assets to it for good reason. But it needs to be done by both like a market orientated way, in the sense of creating the technologies, creating the market mechanisms to solve the problem, but also like using philanthropy to solve the problems that really are not profitable to solve, where, you know, it doesn't make sense for an investor to like try to solve this problem and get their money back. You know, things like humanitarian aid, or you know, providing like you know, maybe like education in third world countries, stuff like that. So so the Huang Chen Foundation focuses on traditional philanthropy to NGOs, and also impact investment to VC managers who are investing in impactful companies, whether it's, you know, alternative proteins, social impact, you know, sustainable clean technology, stuff like that.
Okay, so ESG driven sponsors mainly.
Yeah, that's right.
Yeah, I see. As opposed to direct investments.
Yeah.
And the investments from the foundation, the profits will flow back into the foundation.
Yep. Yeah.
Gotcha.
So hoping to have this, you know, circular flow of profits into that beget, you know, more you know, more contributions to NGOs, and basically increase the capacity for the foundation to give and invest.
I have a conundrum, a question I just can't solve. It's tied to your foundation. Maybe you can help me. This is not investment related, right? So the issues with Mother Earth, climate change, and all the things that your foundation is trying to solve, I think a chunk of it, I don't remember exactly, a third of the climate change or emissions are transport energy, which I believe Elon is really going to solve that issue, right? As we all go electric and solar, you got a third of that taken care of over time, right? And I think another third or 40%, depending on who you talk to, is tied to ag. Farming and ag are maybe even bigger than energy and transport. And I also believe science is solving that with plant-based and lab-grown meats. I think all that I've seen, I've done a deal or two in that space as well, alternative proteins. So I see that. So then you add that together, it's 2/3, right? I forget what the other buckets are, but it seems to me commercial, in particular technology innovations, are solving a lot of these issues that are already solving these issues, and it's good that you're contributing to that. My question and the difficulty that I can't resolve is when it comes down to it, whether it's climate change or poverty or inequality, pollution, everything, to me, it's all tied to population, right? The Earth is not meant to sustain 7.6 billion people, and we're going to go to 10 billion, right?
Yeah.
So what? It's just like unless you solve the population problem, all the stuff we talked about, I think it's technology will alleviate it. But then as the population keeps growing, it seems like the Earth will just get full. Now, birth control and one child, we know from China, does not work, right? Because every prosperous country or person would want to have more than one child. And then even if you did one child like China, it becomes a disaster because of the imbalance of population, right? So how do we reconcile all this? Sorry, I'm kind of rambling a bit. I'm just curious. You put a lot of thought to it. I just feel like a lot of these issues that you're trying to solve are tied to population growth, and there's no ethical or politically viable or even economic way to control the population.
Yeah. So there's a project called Project Drawdown, and they basically study all the different ways that we can get to basically zero carbon emissions, and it's really great. You should check it out because there's so much research that gets put into it, and they actually, try their best to quantify the cost of each, of each solution, and also the carbon impact of each solution. And in their top 10, and they rank them all, down to like, I don't know, top 50 or more. But in the top 10 is educating girls. And, educating girls, especially in the emerging markets, has a huge impact on population because it results in families having fewer kids. And, educated women end up having fewer kids. They have happier, healthier families, more prosperous families. And so to me, that is the most effective and ethical way of reducing population growth. And so we do have a few NGOs that we support in the Huang Chen Foundation that are focusing on that.
Yeah, I think that actually that's point nine. I forget what the exact birth ratio is to sustain the population. It's still quite high. That's why we're going to go to 10 billion.
Yeah,
so
it's scary.
Yeah, and it's also a big part of sort of this Wizard series. My daughter Ia, in one of our many trips in Cambodia, she saw, you've probably seen this in Phnom Penh, a cemetery village. They actually had in like the middle of Phnom Penh, they just ran out of land, and the poor basically built villages, shanty towns on top of cemeteries. So we went in there, and all three of my daughters were so sort of shocked and imprinted in memory. And so the oldest one actually says, she wants to do exactly what you said, is to teach girls investing and financial independence mechanisms, and partially why we wrote this book, and also the website, and partially why we're doing this podcast. So hopefully we contribute that in a much smaller way. But yeah.
There's one organization that we support called Cambodia Children's Fund, and they they do exactly that, and they work in Phnom Penh.
Good stuff. Good stuff. Okay. Hey, Gio, this is fun. Could you, let's say for my daughters, for any listener, what are there any commandments or principles you follow? Again, it doesn't have to be related to trading, just more of general smart business, smart investing philosophies that you could recommend for us as a parting advice.
Yeah, I mean, all the 10 commandments that you wrote in your book are hugely important. I mean, I could literally talk on for ages about each and every one, and it's hard for me to just point at one and be like, follow this one. But I do think, like, respect market cycles is something that it goes back to people being more global macro aware, and understand the growth cycles, the inflation cycles, the liquidity cycles. Those are the big cycles that people just think the economic cycle is one big cycle, but growth, inflation, and liquidity are actually three different things that can cycle independently of each other sometimes. And quarter by quarter, what they're doing will create a lot of effects in the asset markets. And I guess, like, don't lose money, which should be obvious to most people, but they end up making decisions that completely go against that commandment. We saw with Archegos, you can have like $15 billion in assets and lose it all in 2 days with the use of leverage. So I use leverage, but definitely not to that extent. And I for me, like, I don't want to be highly leveraged in stuff that I can't get out of. I always want to keep liquidity in mind. I want to have a stop. I want to be able to risk manage out of the positions. So leverage also, it comes hand in hand with liquidity. And the biggest accidents that happen in the markets is when you have too much leverage and too little liquidity.
Good stuff. Okay.
Yeah.
Great. Well, thank you for not only buying, but actually reading and finishing the book and remembering some of the commandments. I really appreciate that. It's an honor for that for us. How do our friends find you, Gio?
Yeah, I'm on Twitter at Geo Chen.
Okay.
Yeah, so that's the best way to get some of my views. Sometimes I just upload my views or thoughts onto Twitter.
All right, good stuff. Great. So at Geo Chen Twitter to follow you. And then the foundation.
That's HuangChenFoundation.org.
Okay, Huang, Huang, Chen, the two last names. I'm glad you put your wife first. Found it. All right, Gio. Great. Well, again, this has been a tremendous learning experience. Appreciate it. And we'll hopefully get you back on here soon in the near future.
Yeah. Thanks for having me. It's been great talking to you.
Thank you. Thank you.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards.